We're going to move on to our next discussion now, and it's about the balancing act, the opportunities and risks for investors. It's quite a juggle at the moment, and I'm looking forward to hearing the thoughts, the advice, the unique insights that we've got from Greg, Michael, and Jeremiah coming up. John Groneman is going to be hosting this session, the Global Distribution COO, and I think I'm right in saying that you're all together in a room in Denver, which is something we all love to see in these strange times that we've lived through, a group of people together able to share some unique thoughts and insights. So John, over to you.
Great, excellent. Thanks, Lucy. I'm not in Denver, so I'm the only one calling in remotely today from London. But good morning, good afternoon, everybody. As Lucy said, today I have the great pleasure of hosting this session with Greg Wilensky, our head of fixed income and portfolio manager Michael Keough, and portfolio manager Jeremiah Buckley. So welcome, guys. Before diving into our session, I just wanted to remind our audience that Janice Henderson doesn't have a house view. So what you're going to hear today from the PMs will be their own views rather than one on behalf of the whole company. So with that said, let's dive right into some questions. Jeremiah, I'm going to throw the first one over to you. So I think it's fair to say that 2022 is off to an interesting start. And as we wrap up the first earnings season of the year, I wonder if you might share with us some of the key themes that you were focused on during the earnings season.
Yeah, sure. Thanks, John. And it is great to be in the same room as my partners here and share this experience. So, but yeah, we're getting towards the end of earnings season. Fortunately, it's always a stressful and busy time. But for our focus group of companies, U.S. large caps, generally most of them beat earnings estimates to finish the year in 2021. The small number of companies that had difficulties that pre-announced or that missed during the quarter were particularly tied to petrochemical input costs. And so that's a relatively small portion of the market. On the flip side, too, the importance of 2020 earnings guidance, we also saw that was generally in line, if not better than expected, and which we were happy with given all the different variables that companies are dealing with. There were two focus areas that we were particularly keen on during this earnings season. One was understanding whether the secular trends that have really been driving the market and economic growth over the last couple of years, were they continuing to be as strong? And secondly, what is the status of the supply chain? Are we starting to see improvements? And on that first topic, we continue to see very strong growth for a lot of the companies that are benefiting from this transition to a more digital economy. A lot of themes that we've been focused on have included cloud and software as a service, as well as semiconductor content in all areas of the economy. And we saw a lot of evidence of strong data points supporting those themes in this past quarter. Particularly on the cloud services, we saw Amazon Web Services have 40% revenue growth. Microsoft Cloud and their services business had 46% revenue growth. On the software side, this transition to a more digital economy, companies like Microsoft with their Office business had revenue growth in the mid-teens, and a company like ServiceNow had revenue growth of 29%. So continued strength in those themes. Lastly, on semiconductor content, a company like Advanced Micro Devices had 49% revenue growth as they continue to benefit from growth in data centers. And Texas Instruments, an old economy semiconductor company, had 19% revenue growth during the quarter. So a lot of these themes pushing this digital transition continue to be supported by the data that we've seen. Secondly, on the supply chain, while we'd like to see more progress, and we had hoped that we'd see more progress by now, we are seeing a modest improvement in the factors that are driving the supply chain issues across the globe. We're starting to see companies are talking about better availability of labor. We're starting to see more, raw material becoming available, and the component shortages. A lot of companies are talking about seeing improvement in the second half of 2022. So we're not quite where we want to be yet, but we're starting to see improvements. And so both of those factors made us continue to be optimistic about the direction we're headed.
Great, excellent. It's great to hear about some of those improvements. In changing gears a little bit, Greg, maybe I'll come over to you. Inflation's been an important market theme in 2021 and this year in 2022 so far. Can you talk about how we got here at this stage, and what do you expect in the year ahead, and how do you expect those issues around inflation to impact interest rates as you're looking at things?
Sure. Thanks, John. Well, I guess to set the stage of how we got here, I would tweak out Billy Joel's famous song title and say, the Fed didn't start the fire here. If the fire is inflation, clearly it was started by COVID, but we need to think about that the policy response from governments, from central banks has certainly, if you will, added some fuel to that fire. The policy, the response by policymakers certainly saved the economy and markets, starting with the really decisive action they took in the spring of 2020. But now, the response that they put in is adding fuel to this fire and can keep the flames running a bit hotter. I think now they clearly did a great job of saving the market and economy, but with hindsight, I think the Fed will look back and say, you know what, they've kept the pace of accommodation a little too high and too fast and wish they would have pivoted a little earlier, but they have pivoted aggressively. They've brought down the speed of, they've tapered the asset purchases that they're doing. They've brought forward the date of liftoff and the expectation for rate rises, and they've been setting the groundwork for a more rapid reduction of the balance sheet than certainly what we saw in the prior crisis. And I think, even if investors and the population in general and politicians are going to be looking at the Fed as the main firefighters here, even though we've got to recognize they don't have all the tools and they don't have the control over the entire inflation landscape. Thankfully, in that respect, they are going to be getting help on a couple of other fronts. First, one of the other big items that have been helping fuel inflation has been the incredible fiscal stimulus that we've seen, and that's really set to wind down or fall back from the extremely high levels that we saw over the last 2 years. That's going to reduce some of the excess demand that we're seeing in the system that's helping to drive inflation. And then clearly one of the other big things on the COVID front is the supply bottlenecks that have been caused by COVID. In our view, while believe me, this has gone on longer than I think than certainly we and almost everyone expected to have happen, we believe that will be moving in the right direction. You'll start to see a reduction in those supply bottlenecks, as Jeremiah was talking about, and that will help cool inflation a bit as well. Right now, if you look at the break-even inflation rates that are implied by the tips and treasury markets, you'll see that for the calendar year 2022, you're looking at kind of an implied inflation rate of around 3%. And then for 2023, still a number in the high 2% area. And I think if that, when we look at that, we think those are pretty reasonable levels, although I would note that I think the risk is still tilted to the upside around that. But if we see inflation develop that way, the Fed, who is absolutely being data dependent in their decisions, will be able to raise rates at a gradual pace. I would say 4 hikes a year for the next couple of years would be consistent if we see inflation in the economy evolve the way we believe they're looking at it and how we're looking at it. If that's what happens, we've had a pretty sharp increase in interest rates already this year. We thought rates were too low coming into the year. We would still look out and say, even after this boost in rates, that we would expect rates to continue to rise and longer-term treasuries to underperform cash, but the pace is going to be much more moderate than it has been in the past in the year-to-date period.
Great. No, excellent. I want to grab one of those topics that you just covered and Mike, maybe throw it over to you, which is around kind of central bank activity. The central banks over the last 2 years have been a pretty powerful force in the markets and the economy. So I wanted to dive in here on a few topics, and first of which was, how do you see central bank policy changing this year, and how many of those changes, and how might those changes impact the market? And kind of on the back end of that, what risks do you see these changes creating as we move forward?
Yeah, thanks, John. I think to start, you just got to step back and acknowledge what the central bank did over the last few years. They came in with the pandemic-induced recession. They went all in with policy accommodation. They pulled out new tools that they hadn't used before. And what that resulted from the trough in March of 20, we had the S&P 500 index double. You had credit spreads go to their tights. Interest rates generally remained low and accommodative. And I'd say the Fed stepping back and looking at it would say that policy implementation was successful. The economy is back to growth. Markets navigated that. And they made progress towards their two mandates. They were approaching maximum employment, and they also got inflation up towards their average 2% inflation target. But I think you have to, today we're at much more of a crossroads. Yes, they achieved that inflation that they wanted, but they got more than that. Greg talked about it being more persistent and higher than what they kind of expected. So that's going to result in them having to pivot. They have to, all that accommodation that was tailwinds for us over the past few years, they're starting to remove some of that. So that's what we're focused on as being a big driver. What is that pivot going to look like? First, we're going to see the final phases of the last asset purchases of quantitative easing. They're ending in this month in February. Next, in March, we're going to see the first rate lift off. And then in the second half of the year, we expect them to do quantitative tightening or starting to reduce that $9 trillion balance sheet. And so often you look back for the last cycle and to say, how does it compare? How does it differ? In 2015, we had our first rate hike. We didn't have quantitative tightening for 2 years later. Now we're going to see it in a pretty compressed timeline. And so it's important to take note of that. I would say, what do we think the impact, what does that cause to the markets? What are the things that are going to play out because of this pivot to accommodation, to removing it, and then potentially something that may turn from the tailwinds to abate and maybe even headwinds as we get through this? We expect an increase of volatility. We're seeing that here today. We have, whether it's stocks or bonds, significant moves across asset classes to start the year. Those higher interest rates also brings in a new environment. Different stocks or fixed income securities, they perform different in a rising rate environment. So this year, we think it's really crucial to focus on your security selection and sector selection to find names that are going to perform well. And lastly, I'd say we expect some of that volatility to persist and create opportunities. And so I would say, John, before I started here at Janus, I was a pilot in the Air Force for a few years. I'll tell you that when you take off, all you do is pull back on the throttle, and it's really easy. When the Fed puts in policy, they just come in with all force. But we're hoping for that they can navigate a soft landing in the economy. That's a lot trickier, especially with the cross currents we're seeing. We're in an environment we haven't really been in before with this amount of inflation and this kind of reopening in the supply chain bottleneck. So we expect, compared to what we've seen in the past few years, higher risks, more opportunities to be active across portfolios.
Great. No, excellent. Transitioning from kind of landing the plane on the runway, I'd like to go back, Jeremiah, your direction here, and a little bit connected with my earlier question about some of the themes you were seeing coming out of earnings season. Could you share with us some of the sectors where you see the most opportunity for 2022 as we look forward?
Yeah, John, so the interest rate environment and what the central banks are going to be doing, certainly impacts your kind of sector selection in this type of market. I think, with rates going higher, the inclination is to, load up on financials. But I would say that decision is a little bit more complicated. There are a lot of factors other than just interest rates going up and how that impacts net interest income, because it depends on loan growth. It depends on credit losses. As we have, higher interest rates, consumer health will vary depending on the different kind of credit buckets that banks are in. So I think you have to be careful when you're just focusing on financials. You also have to be careful in those sectors that are kind of bond proxy sectors as well, that have heavy amounts of debt, like real estate or utilities, because certainly their interest costs are going up and the discount rate for them is changing. And then lastly, companies that are growing rapidly but don't have profits or cash flow yet, as we've seen over the last couple of months, those companies are certainly impacted by an era or environment of higher interest rates. Some of the areas that we're focused on, we continue to be positive on, I mentioned all this spending that's going on in this digital transition of the economy. We continue to believe that there are a number of tech-oriented companies that will continue to see strong secular growth throughout this period, regardless of kind of what interest rates are doing. The S&P 500 information technology sector is down 7% year to date. So some of the impact of higher interest rates is already reflected in some of those valuations. Another good sector, consumer discretionary. While we have to monitor what interest rates and how that impacts consumer spending, we continue to see very strong data points on wage growth, and consumer balance sheets continue to be extremely healthy. That's another sector that's down 7% year to date. So the market is already reflecting some of that impact of higher interest rates. And so we're finding some good opportunities there. And then lastly, we think, we've talked a lot about supply chain today. We think that there's going to be an acceleration in supply chain spending to add more flexibility for companies. We also think they're going to spend a lot more on automation and continue to spend on technology. And so we continue to find attractive opportunities within the industrial sector, which is down 4% over the last 3 months as well. And these spending trends will also help technology companies as well.
Excellent. Thanks for that. I mean, it's clearly a very interesting environment we're finding ourselves in with, we've been talking about rising rates, inflation fears, heightened volatility. Jeremiah, if I could come back to you quickly, we've been talking about the opportunities that you and the team see in the equity market. So maybe we could just take the other side of that question for a second and look at the risks that you see out there in the market. When you look forward to 2022, what keeps you and the team up at night, and what are you guys most concerned about?
Yeah, John, good question. So what the environment that we don't want to get into is an environment where inflation continues to persist as a problem, forcing central banks to be more aggressive than this kind of gradual pace of interest rate increases. And so what we're focused on is making sure that the supply chain starts to improve and correct itself, such that that helps kind of slow down some of this inflation impact that we've been talking about and seeing in the recent CPI numbers. So what we're focused on is labor supply. So that's been a big part of this. We're focused on labor participation. We've seen some improvements. Companies, as I mentioned earlier, are starting to see some easier availability of labor. And so that's extremely important. That's been extremely important in the supply chain and transportation of goods as well. And so obviously COVID has had a substantial impact on that. So to the extent that the world can continue to improve and reduce the impact of that on the labor supply, that will be beneficial. And secondly, the availability of raw materials and components that are needed for production of goods. We continue to monitor that as well. Obviously new supply and raw materials would be helpful, but that's more difficult in this type of environment. And so those are the factors that we're watching, because again, we don't want central banks to be in a position where they have to aggressively increase rates to materially reduce demand because of these inflation issues. And that's what keeps us up at night. And that's some of the factors that we're monitoring. Excellent.
No, really helpful insight. And looking at the clock, I think we've got time for one more question for this session. So maybe we'll do kind of a dual one, between Mike and Jeremiah on this. One of the great characteristics of the Balance Fund is that you guys are able to invest in markets across asset classes. With what we've discussed around secular growth, inflation, central bank policy, it'd be great to hear how you guys are thinking about the return outlook for stocks and bonds in 2022. And maybe I could throw it over to Mike to start on your views of the bond market.
Yeah, it comes back to one of the key things we've been talking about, the direction of interest rates or inflation. And I'll say that in 2021 and when we came into 2022, we expected higher rates, economic growth, inflation, and normalization of policy. So we've had less of an optimistic outlook for returns. And you can see that playing out. The most widely used bond index is the US Aggregate Index. In 2019 and 20, it had high single-digit returns. Then in 2021, as rates started to move up, it had a negative 1.5% return. As we start the year right now, it's down 3.5% as rates have moved up. And so some of those views have been playing out that we've expected subdued or even negative returns across the market. And as this normalization process happens, I will say that we still think a little bit of it more has to play out, but what happens, you get higher yields. Your starting yield is a big driver of fixed income returns. So as yields go higher, it'll give you more income and more return. And then the other aspect of it is what role can fixed income play as a diversifier within a portfolio? As we've come on from that low in rates of 60 basis points on 10 years, almost up to 2% today. 2% on 10 years is actually where we went into the pandemic with. And fixed income did a pretty good job at providing diversification if you have a severe economic slowdown and providing a hedge. And so I still think we have a little bit to navigate because we do think we're moving a little bit higher, but there's some positive things that come out of that which will help improve the outlook for fixed income.
Great, excellent. Jeremiah, anything to add on top of the comments you've already made around kind of your views for the equity market?
Yeah, sure. Just briefly, John, on equity markets, it's going to be a battle between earnings growth and then potentially some multiple contraction if we see this interest rate environment play out. And so, at this point in time, we continue to be optimistic about the potential drivers of earnings growth for a number of areas of the market. And so we think that earnings growth will more than offset any multiple contraction that we see from interest rates going higher and bond yields going higher. But that's what we're watching for, and certainly that's going to impact returns for overall equity markets during the year to come.
Great. Well, looks like we've run out of time, guys. But I just wanted to thank each of you for all of the insights that you shared with us today on your views of the market and where we're headed. Thank you so much for the time. And I guess with that said, Lucy, we're going to turn it back to you, I think, to close us off on day one.
John, thanks so much. And thanks to you all in Denver. Really fantastic to see you all there today. Greg, Michael, and Jeremiah, really great session.